Good evening, everybody, and thank you very much for joining us this evening, and thank you to the guys for organising it tonight and for the invitation to speak, of which I'm very grateful. So I just want to do sort of a relatively short presentation about Anglo-African, because actually it's a fairly short and simple story, but then I'm very happy to answer as many questions as people might have. So who are we? Most of you probably have not heard of us. We are a very small E&P company, which listed on the stock exchange about 2 years ago. This gives you a reasonable description of what we have, but let me just start off perhaps with the why. And the thinking very much was that, and I come from a private equity and law background, although I've been in the oil industry most of my career, was that we could do things kind of slightly differently with the small E&P world. Why do people buy small E&P companies? You buy them not for cash flow, because if you're going to buy cash flow, you buy BP or you buy Shell. People buy them because if something comes up on the exploration side or with a mature asset, you get a multiple return of capital deployed. So that's critical. But at the same time, it always seemed to me that that is not incompatible with a focused, careful attention to cash flow. In other words, if you pick the right asset, you can always protect the downside, which gives you then an interesting play on the upside. And you avoid what I always think of as the existential risk with most E&P companies, which if things don't come off, you end up with nothing. So we decided to look at various assets, and the criteria was something which was an existing producer, which had some cash flow, had easy development targets, which we could run in a very cost-efficient, cost-focused basis, but also had that exploration upside, which would get the E&P investor interested in it. And so we settled on an asset called Tilapia, which is a small field straddling onshore and offshore in the Republic of Congo. The Republic of Congo, for those who don't necessarily know, is not like the DRC, the other Congo. It's the nice one in the north with the decent croissants. It's actually the oldest oil producer in the Congo, in Africa. And we bought this field for $5 million. Doing about 45 barrels of oil a day, which is pretty much the most boring thing you've ever heard of in your life. The reason we bought it was because we could see where the field was, and it sat on top of 3 layers. And I'll go through the layers in more detail in a sec. But essentially, one of them provided us with development upside. One of them was an appraisal layer, which could, in and of itself, make the asset cash flow positive without any exploration risk. And then a very, very high impact exploration target, which provided this would be potentially quite significant upside and the reason for being interested in this in the first place. We also wanted to set it up in a kind of slightly different way in that we needed to have a very, very clear focus on the PE side of E&P. It's one thing to find oil in the rocks, but that's not actually what the oil business is about at the end of the day. It's not actually about the rocks. It's not about oil in the rocks. It's not even about getting oil out of the rocks. It's about when you sell a barrel of oil and somebody else gives you $50, $60, $70 in return for that. Like every other business in the world, at the end of the day, it's about cash flow. And too much of the, particularly the speculative end of the oil industry, is all focused upon proving assets. But actually, say you have an exploration license, you make a great discovery, well, that's fine. You are at that point probably 5 years away from actually producing any oil. You've got to spend $10, $20, $30 million on topside facilities. You've got to find an offtake agreement. You've got to find some way of getting it to the offtake recipient. In other words, you're a long way from actually selling oil. But by buying an existing producer with the offtake agreements in place, the facilities in place, anything that we ended up finding on the appraisal or the discovery side could be turned into cash very, very quickly. Where we are today is we've drilled a well, 103C, and I'll talk you through that well in a sec. We are very focused on bringing that into production and doing a well development program. We do want to look at additional acquisitions going forward, which are consistent with the strategy, but our first and foremost focus is on the asset we already have. And we have a commitment which we retain, which is the discipline of the dividend. And this probably relates to my private equity background, which is capital has a cost. And it's really important that the ops guys, that everybody in the business understands that capital has a cost and ultimately it has to be paid through cash flow. So we have a standing commitment that after CapEx, we will pay an increasing percentage of revenues of net free cash flow through as dividends. So, the asset we bought, as I said before, straddles onshore and offshore. In the Republic of Congo, we have 56% of it. 44%, the balance is held by SMPC, which is the local state oil company. Offtake agreement in place with the Carif. It's about 17 kilometers down the road to sell the oil, and we sell oil every day. Every day we bring oil out of the ground. Every day we sell oil. Very, very few small E&P companies that do that. We're well advanced in extending our license, and we have extremely good relationships with the government. So we drilled a well, and this was the proposition behind the listing. The well had 3 targets. First of all, to go into the R1, R2, R3 sands. Those are the sands from which we currently already produce from another well, 101. The chance of success in the CPR was 90%. We encountered oil when we went through R1, R2, R3. We actually encountered an oil column which is about double the size that we were expecting and double the size from the other well. We then went into the Mango sands. Mango is a bigger prospect than R1, R2. It's a horizon and a structure which extends over most of the Congo and Gabon. Widely brought into production. Usually comes on stream about 700-800 barrels a day, declines to 400-500 barrels a day. We had the chance of success at 60% in the CPR. We'd always thought, and part of the sort of the backstop thinking on this was that because we had proven oil there in our area, but we'd never properly tested it, that our working assumption was that in reality our worst case scenario was R1, R2, and the Mango. The Mango came in, it came in again at roughly double the size of oil column which we've been led to expect by the geophysicists. And below that was the Geno. Now the Geno is a different beast altogether. It's a massive offshore structure where Total, Eni, and others have drilled wells. The average production, barrels per well per day from the Geno is 5,000 barrels a day. Obviously, utterly transformational for a company with a 25 million sterling market cap. If I can be just absolutely honest for a sec, I never thought for a minute, well, perhaps overstating it, my genuine assumption and genuine hunch was that we would not find oil in the Geno on the first well, that we might find information about it, and we certainly built a plan around making sure that we were a very profitable company just on the Mango and R2. But we encountered oil in the Geno. We've actually only been through the upper part of it, which was the least likely part to encounter oil. The sandstones which are below it will go through into the next well. But it's been a phenomenal success, much, much better than we could possibly have hoped. And from that, we really want to create a very interesting, very disciplined oil company. This goes through what we've achieved to date this year, but I don't think it's too interesting. But to summarize what we achieved here, it was a well which went to 2.7 kilometers down, deviating offshore. Not an easy well to drill. An aggregate of 56 meters of oil columns across the 3 pay zones. There are not many small E&P companies who have had great success on drilling this year, which is not in any way to criticize them, but after what some of you may know was kind of quite a difficult journey through the well, to achieve results which totally exceeded expectations was quite phenomenal. So what are we going to do from here? We're not going to bring the Geno into production from 103C. Where we went into it, the structure of how the well itself looks when it goes into the Geno means it is unideal to produce from there. So we will produce from a commingling of the Mango and R2 from 103C. We hope to bring this into production in sort of April, May this year. We're just really waiting on the right equipment to come through. Interestingly, the R2 part that we drilled through, we were expecting that to be contiguous with the R2 that we already produced from, so boring 50 barrels a day. The pressure shows that it's separately faulted and is identical to R2 reservoirs before they are ever brought into production, and is identical to what our R2 reservoir was 10 years ago before that was brought into production. Why does that matter? I mean, in the long run, the money's all in the Geno. Where it matters is that the initial flow rates out of R2 are very large. They decline very quickly within 12 to 14 months. But for that first 12 to 14 months, you can get in excess of 1,000 barrels a day just out of R2. When do we need the cash flow? We need the cash flow now to drill the well to bring the Geno into production. The fact that we can largely do that off the back of cash flow from what we found today and a well that we're going to bring into production within a month or two, hugely significant for us as a company. So the first target is bring Mono 3C into production. The Geno, fairly consistent well results across the people who brought it in, about 5,000 barrels a day. As wonderful as it is to have topside facilities, there is just no way realistically they can cope with Geno production. So before drilling a Geno-specific well later in the year, we need to enhance the topside facilities, look at a pipeline to the export terminal. We have one of the super majors interested in working with us on that, and we're in discussions with them. I can't guarantee it'll go anywhere, but they're very interested in the oil and very interested in how we would finance that. And we've agreed with the government a 6 to 8 well development program taking this forward. Where do we come out the other side of this? In the short term, we come out with production of around about 1,000 to 1,500 barrels a day. That is about $1 million of net free cash flow to us based on our share of the field. SMPC, who hold the other 44%, owes approximately $10 million because we've carried them through the well. They've started paying us back for that. To the extent there is money still outstanding when the well comes into production, we can recover that through their share of the revenues. So between $1 and $2 million a month of net free cash flow, more than enough to take this company forward. We have cash on the balance sheet. We have SMPC starting to repay the debts that they owe us. And we're very focused on developing this field. What we are not doing is what lots of other small E&P companies do here. We're not finding sort of 10,000 acres of jungle somewhere and spunking it all on an exploration well. It's cash flow, it's production, it's discipline. These are interesting numbers about the other people who've drilled into the Geno structure offshore. And they give you a sense of the scale of what we're talking about. And you just look at the NE fields alone. And we're talking billions of barrels of oil. Now, that's not what we're going to have. We're a smaller field, and we're at the edge of the Geno. We know there's oil there. But even if it was just a few hundred million barrels of oil, look at that compared to our market cap. Look at the fact that we'll be able to cover our own costs through production out of Mengo and R2. It's a very, very significant find. So why do we think this company is interesting? We think we've got a nice asset. We're already producing. The appraisal and exploration potential has come through. We're very focused on costs. We now have proof, actually beyond what we thought was possible, of what the reserves are. We're in a good location. The management is very experienced. We're very aligned.